Let's take a look at that stock market and what it did on an intraday basis and how the news affected it during the week. This is a 60-minute chart of the S&P 500, the gray areas being overnight and the white area, the normal day trading or pit trading period. Here's that news that came Friday. Look what it did. It gapped from this all the way up to here. The market was excited about that China deal. It opened higher, you can see here, and then basically chopped during the day. Made a nice triangle that you could see right in there. And then overnight, we had an upside move again as good news came out of China. Again, they were going to lower their tariffs on cars coming into their country. So our auto companies, well, those stocks did pretty well. Wednesday was the big news day in here, and you can see in here after that opening here on Tuesday that gave up the whole advance and started to move down. That news came out that Trump said that the trade deal is just too hard to do. The China market dropped 2% on that news, and then the Italy bond rout was going on. The Eurozone, their purchasing managers index all came out weak. Turkish lira cracks in a big way, which sends the yen up just tremendously. And then the bonds got their first decent pop of 1% right there, and that caused all of this selling overnight. But then, as often happens, the market firmed, as you can see right in here, as they were waiting for the Fed. Well, the Fed came out with their minutes, and they were actually pretty dovish. They said a June rate hike was likely. They said the labor market's not overheating, and the yield curve seems to be less reliable. And it seems like every time something comes that could be warning of trouble, they make it less reliable or completely erase it. If you can remember back at the beginning of the financial crisis, when all of the banks were deeply underwater in much of their holdings, they just simply got rid of FASB 109 and said you don't have to mark to the market anymore. So if it could be bad news, we're going to get rid of it. And that's exactly what they're saying here, that the yield curve seems to be less reliable. What happened? Well, as we do very often, we got a big rally here after the Fed minutes. And then right afterwards, we get this point here that the president made that he was going to look at putting tariffs on foreign cars. We got this busy overnight period in here. Oil drops right over here on growing U.S. stockpiles, and home sales fell and home prices are increasing. They jump 8.7% year over year. That's the fastest in 12 years. And then the market heads down on that as President Trump canceled the Korean summit, and you could see we got wailed on right in here. But then a big V bottom as it reversed and came back up. And then on Friday, we got pressure in here. Oil was down $2 early right over there. It's down over $3 right now, as Russia and the Saudis came out and said, well, they're going to pump more. If the Iran situation and those sanctions mean there's less Iran oil, then they're just going to pump more. And of course, we have this huge growing stockpiles in the U.S., and you know, with oil at 70%, the shale producers are going to produce more. So lots of oil out there. There's no worries, and that sent the energy stocks down sharply. And oil down sharply is weighing on the market here on Friday, and as we're on a pre-holiday period, and that is very much a look at what happened in the last week and all of this news that seemingly keeps moving the market around. So the stock market, we had expected that it would drop, and then the time that it could rally would be late in the week. That pattern was mostly right, except that it didn't get down as far as we thought. And the bounce looks like it may be coming more early part of next week. So we get only partial credit for our stock market call. We had anticipated that it would be a narrow range or a small change week, which it absolutely is. Now, when I show you this chart, I'm going to show you why I thought it would be a narrow range. Where we were getting into was this pattern right over here, where this correction likely comes and this rally likely comes. That's why we thought we'd have a dip. And this is the second week in a row we said 2682 that it didn't get down to. You could see momentum strong still, and as the slim ribbon keeps it strong, and that 13-day moving average, the blue line, still giving it support. Now, we were running into this downward resistance right over here, and we were getting this upward move right over here, and this bigger pattern pushing up. That all said to me this was going to get squashed, and we were going to get a narrow range. And of course, when we're coming into a holiday weekend, it tends to do that. Well, it just did not get anywhere near the decline that we expected, so it changed the pattern by a little bit, but not much. Here's what we're getting into right now, and that is that, you know, if this pattern right over here is this right in here, then you probably get a little attempted move in there. But this is a period of risk. So we're really looking at a period of risk here, and then another one that comes out over here. So we think that there's the upside in the market is extraordinarily limited. Again, this area of 2744 really looks like about the best to us. And then getting into this really risky period over there for decline. In the beginning of the show, I said I thought that there would be a 125 or 150 point decline coming in the market into June. And that's this whole period that we're looking at right in here, and maybe extending out with this cycle right there. So this is a really potential period for the markets to fall very hard. It could just fall at its own weight to complete this pattern, or maybe some of this background news starts to get worse and then pushes the market down. We think that in the next week or 2 weeks, we're going to fall below this level of 2668 with a potential of moving down towards this 2600 level right over here. That would be about 140 something points off of this peak right over here, and we think that is reasonable expectation. So that's really looking out for the next 2 weeks. The if the market tells us that it's different by getting above this 2744 area and holding above there, then we will again look at the potential that there are changes in here. But this is the highest potential, this engulfing pattern, this downside gap from that 2744 area, telling us that that resistance that we thought was there from the weekly is playing, and that the market has got trouble. In my mind, the question is more, do we get rally at all in here? Or does it just start to move down? If it gets below this 89-day moving average, under this 2706 area, you've got to then start to believe that, well, maybe there is no rally. Maybe they can't hold up and then start to move down. Yes, I think we're moving into a very risky period in here in the market. And outside of next week, that 4 days in the holiday week, when I think you could get a little more attempt to the upside, I think that the market is moving into a risky period. And we're going to look for the stock market to have some significant downside during this period right in front of us.